Welcome. It is great to have you back with us. Today, we've got a bit of a financial mystery on our hands. I think you're really going to find this one, well, puzzling.
Is a very interesting case study, definitely.
We're looking at the 2025 year-end numbers for Burgan Bank A.Ş. And right off the bat, there's this huge contradiction that just jumps off the page. I mean, imagine a business that grows its total assets by nearly 43% in 1 year.
You'd be celebrated.
You'd pop the champagne, right?
Absolutely. In banking, that kind of asset growth is often the headline everyone is chasing. It means more market share, more influence, just a bigger footprint.
And here's the kicker, while they were doing that, their net profit actually dropped.
Yeah, by over 25%.
It's the classic case of bigger isn't always richer. So our mission today is to decode this. We aren't just reading a spreadsheet. We're trying to piece together the story of a bank navigating, a very volatile Turkish economy in 2025.
That's exactly the goal. We need to look past those top-line vanity metrics and really understand the quality of that growth. And maybe more importantly, the cost of that growth.
Right.
And just so everyone's clear, our source material today is the consolidated financial statements and the independent auditor's report for the period ending December 31st, 2025. This was all audited by KPMG, so we're working with verified numbers.
Let's first get to know the company a little, because I think before we judge their wallet, we should probably know who they are. Burgan Bank A.Ş. It sounds local, but that name, it hints at something else.
It does. Burgan Bank A.Ş. is actually the Turkish arm of a much larger group. It's 99.41% owned by the Burgan Bank Group.
And they're based where?
Burgan Bank A.Ş. They're headquartered in Kuwait.
So they have some pretty significant international backing. This isn't just
Yeah.
a standalone Turkish bank fighting the currents alone.
No, not at all. They have let's call it a big brother in Kuwait. The headquarters for this Turkish subsidiary is in Istanbul, but when we look at these financials, it's not just one bank. This is a group consolidation.
Okay, so it's a family affair. What else is in that family portrait?
The figures we're looking at include the bank itself, plus its key domestic subsidiaries. So you have Burgan Financial A.Ş., which is their leasing arm.
Okay.
And you also have Burgan Yatırım Menkul Değerler A., which handles securities and investments.
That's always so interesting to me. It means they're not just taking deposits and giving loans. Through one arm, they're leasing heavy machinery, and through another, they're playing the markets.
It diversifies their revenue streams, or at least that's the theory. It lets them capture a client's business at multiple points. A company needs a loan, the bank's there. They need to lease a fleet of trucks. The leasing subsidiary steps in.
I see.
And they also have an interest in a company called Burgan Wealth Limited in Dubai. But I should note that one isn't consolidated in these specific reports we're looking at.
Got it. Now, I always like to look at the people steering the ship. Who's in charge here?
Well, looking at the signature block of the report, the chairman of the board is Emin Hakan Emensoy. And the general manager, who's basically the CEO running day-to-day operations, is Ali Murat Dins.
Okay, and I noticed something else in that signature section about the board composition. Sometimes these lists can look a bit uniform.
You're probably talking about Zeynep Bozkurt being listed there.
Exactly.
Yes, and that indicates female representation at the board or senior management level. In modern governance, especially in financial institutions, which can be so traditionally male-dominated, tracking that kind of diversity is an important metric. It's about perspective and, honestly, risk management.
Speaking of metrics, I found a number that might make our listeners sit up a little straighter. We always talk about key management personnel, the board, the GM, all the deputies. In 2025, the total benefits paid to this group, salaries, bonuses, everything, came to 401,171,000 TL.
That is a significant figure.
It is. That's over 400 million Turkish lira. And just for context, the year before, it was around 282 million. So that's a pretty hefty raise.
What does that work out as?
About 42%. In a year where, as we just established, profits went down.
Wow. It almost perfectly mirrors the asset growth, doesn't it? Assets grew 43%, executive pay grew 42%.
So what does that tell you?
It suggests a compensation structure that is maybe rewarding scale and size rather than just immediate bottom line profitability.
Or could it just be keeping pace with inflation given the environment in Turkey?
That is certainly a factor, a big one. But either way, it's a substantial outlay of cash.
So let's look at what they actually do to earn that. What's the core business here?
They're primarily focused on corporate and commercial banking, though they are growing their digital banking side. And if you look at their assets, loans make up 57% of the total.
So at the end of the day, they lend money.
Yes. Despite the investment arm and the leasing arm, the heart of this beast is still lending money to businesses.
Okay, so before we dive into the heavy math, let's do a quick vibe check, a little SWOT analysis. If you had to summarize their position, what are we seeing?
Okay, so strengths.
Mm-hmm.
They've got that strong, quaddy parent group backing them up. That capital support is crucial, and clearly they have the ability to grow assets like crazy. Their capital adequacy ratio is at 16.84%, which is, healthy enough for the regulators.
And the weaknesses.
The declining net profit margin is the big flashing red light. They're making less money on more volume. And as we'll get into, a heavy reliance on wholesale funding that's borrowing from other banks.
Right. What about opportunities?
Their core banking revenue, what's called net interest income, is booming. The fundamental business of lending is actually working very well. If they can just get their costs under control, there's a lot of potential profit there.
And finally, the threats.
Market volatility. Simple as that. This report itself talks about trading losses, and they're setting aside these big reserves for economic uncertainty. They know they're operating in choppy waters.
Okay, that sets the stage perfectly. Now we can move on to our analysis. Let's crack open these spreadsheets. You mentioned the asset growth earlier. Give us those big picture numbers again.
It is staggering. So in 2024, their total assets were 123.6 billion Turkish lira.
Okay.
By the end of 2025, that number hit 176.5 billion.
Wow, that's a 50 billion lira jump in 1 year.
To put that in perspective, it's like they added a whole new medium-sized bank to their balance sheet in just 12 months. That takes some really aggressive sales and lending.
So they're getting bigger. But let's look at the income statement. This is the profit story. If they have 50 billion more in assets, surely they're raking in the cash.
Well, the revenue line looks fantastic.
Yeah.
Their net interest income, that's the difference between what they earn on loans and what they pay on deposits.
Yeah.
It surged. It went from 5 billion lira in 2024 to 8.48 billion in 2025.
Hold on, let's unpack that. That's almost a 70% increase in their core money-making machine. That sounds incredible. So why aren't we celebrating?
It is incredible. And if the report stopped right there, the shareholders would be throwing a party. It shows the core engine is powerful. They are lending money at a very good spread.
But the report doesn't stop there.
No, it doesn't. Despite making so much more on interest, the bottom line, the net profit fell from 3.5 billion lira down to 2.57 billion.
So where did all that money go? It didn't just vanish.
It went to the markets. The main culprit is a line item called net trading profit loss. In 2024, they actually made a profit of about 566 million lira from trading.
Okay.
But in 2025, they took a net trading loss of 1.28 billion lira.
Ouch. That is a massive swing, from making $500 million to losing over $1 billion. What even is trading for a commercial bank like this? Are they just gambling?
Not exactly gambling, but they are taking positions. It's mostly driven by losses in derivatives and foreign exchange swings. When you're a bank operating in a volatile currency environment, you use things like swaps and options to hedge your risks.
So they're like insurance policies.
In a way, yes. But sometimes those hedges cost a lot of money, or the market moves in a way that makes your insurance incredibly expensive. And in 2025, the market moved against their positions. Big time.
So the core business is printing money, but the trading desk, or the cost of protecting that money, is just eating up all the profits.
That's a perfect analogy. It's like winning a race, but then crashing the car right after you cross the finish line. The repair bill for the crash ate up all the prize money.
Let's talk about cash for a second. Accounting profit is one thing, but do they actually have cash in the vault?
They do. And interestingly, their cash and cash equivalents actually increased significantly, went from about 12 billion lira to over 16.3 billion, and their operating cash flow was positive over 6 billion.
So they aren't bleeding cash, they're liquid.
Exactly. The engine is running just fine. It's just that the accounting for those trading losses is what's hitting the scorecard. They can still pay their bills, meet withdrawal demands, no problem.
Okay. Now, you mentioned earlier they rely on wholesale funding. I want to dig into their debt and liabilities. How are they paying for this massive 50 billion lira expansion?
Well, customer deposits did grow nicely from about 52 billion to 65 billion lira. That's good. That shows customer trust. But the real story is under borrowings, or a line creditor.
Okay, I'm looking at the line item.
Wow, it nearly doubled. It went from 36.6 billion lira to 66.2 billion.
So they borrowed an extra 30 billion lira from other banks and financial institutions.
That's it. That is the fuel for that massive asset growth. They borrow huge amounts of money to turn around and then lend it out or invest it.
That feels risky, doesn't it? I mean, if the cost of that borrowing goes up.
It creates a lot of pressure. This is what we call leverage. When you borrow money to make money, it's great when your margins are wide. But if interest rates spike, that wholesale debt becomes very, very expensive to service. It makes the whole bank much more sensitive to interest rate changes.
And they also increase their subordinated debt, right, which
Yeah.
is a sort of special type of loan.
Yes, that went up from 7.1 billion to 8.6 billion lira. Think of it as a hybrid between debt and equity. It counts as Tier 2 capital, so it helps them meet regulations, but it's still debt they have to pay interest on.
Speaking of regulations, let's check their vitals. If they're borrowing this much and growing this fast, are they still safe? How's that capital adequacy ratio?
It's standing at 16.84%.
Is that good?
It's healthy. It is above the legal minimums required by the Turkish banking regulators.
Oh.
But context is everything. The previous year, it was 21.93%.
Whoa, that's a pretty steep drop. 5 percentage points in 1 year.
It's significant, yes. When you grow your assets, your loans, by 43%, you consume capital. Every loan you write has to be backed by a little slice of equity, so that rapid expansion ate into their safety buffer. They're still safe, but they have less wiggle room than a year ago.
It sounds like they burned a lot of fuel to get that extra speed. And what about the shareholders? The people who actually own that equity?
Well, the shareholders' equity did increase to 12.95 billion lira, mostly because they retained some earnings. But their paid-in capital was flat.
But if equity went up and profit went down,
Then the return on equity, or ROE, took a big hit. The denominator equity got bigger, while the numerator profit got smaller. So the return on investment for shareholders has tightened a lot this year.
owning a piece of this bank became a little less lucrative in 2025.
On a percentage basis, yes. They're using more capital to generate less profit.
Okay, I want to get into the weeds now. We always find the best stuff in the footnotes. You flagged something about a free provision and a qualified opinion from the auditor. That sounds pretty dramatic.
It is a little bit of corporate drama, yeah. The auditor, KPMG, they gave what's called a qualified opinion.
And qualified usually means yes, but.
Exactly. The but, here's a provision of 165 million lira. Management set this money aside specifically for possible negative developments in the economy and markets.
Wait, isn't saving money for a rainy day a good thing? Why would the auditor flag that as a problem?
It sounds prudent to you and me, for sure. But accounting standards, like IFRS, are very strict. You generally aren't allowed to set aside money for theoretical future risks. You book provisions for losses you know are coming, or that you can calculate based on a specific model.
Ah, I get it. So the auditor is saying you can't just hide 165 million in a cookie jar just in case things go bad.
Precisely. Because it distorts the true profit picture for the year. The auditor is saying the profit should technically be 165 million higher, but management is being conservative. They're saying, look, the market is crazy, we want an extra buffer.
So they're willing to take a qualified opinion, which is kind of a black mark, just to keep that cushion.
It tells you something, doesn't it? It shows they're genuinely preparing for more uncertainty, even while they're growing so aggressively. It's like they're driving fast, but keeping a foot hovering over the brake.
Let's go back to those derivatives. We saw the big loss on the income statement, but how big is the actual exposure here?
It's massive.
Yeah.
If you look at the off-balance sheet commitments, the total is 359 billion lira.
359 billion. That is double their actual assets.
It is. Now, this is common for modern banks, but it's still a huge number. It includes things like guarantees and letters of credit, but a huge chunk of it is derivative transactions, swaps, futures, options.
And the notional value of those is what we're talking about, the total value of the assets being hedged.
Correct. They aren't betting 359 billion in cash, but they have contracts that reference that amount.
And that explains why that trading line can swing so wildly. A tiny percentage move on 100 billion in derivatives is, well, it's a billion.
Exactly right. It explains the volatility. They are using these tools to manage their risk, but when the waves are high, the boat rocks violently. It's very high-stakes risk management.
I also noticed in the segment reporting that it wasn't a uniform story across the bank.
No, not at all. It's a mixed bag. Corporate and commercial banking are the heavyweights. They're carrying the profit, generating that huge interest income. But the treasury segment, that actually showed a loss.
Which makes sense. That aligns with the trading loss we just talked about.
Yes. The treasury is where those derivative losses sit. But there is a bright spot. Digital banking. It's listed as its own specific segment now, with significant assets of its own, 16.3 billion lira.
That's about 10% of their total assets. That's not a side project.
It's a strong signal. It shows a real strategic pivot toward tech-driven banking. It's a core pillar of their balance sheet now, which is crucial for future valuation. Digital banking just scales so much better than traditional branches.
So putting it all together, we have a bank growing like a weed, borrowing heavily to fund it, making fantastic money on its core lending business, but then losing a big chunk of that on market hedges.
That is the summary in a nutshell. Burgan Bank in 2025 was a story of aggressive expansion and core success, offset by market volatility and the cost of all that leverage.
So what's the takeaway for an investor looking at this? Should I be worried or excited?
I think if you're a retail investor, you'll have to look at the risk profile. This is a bank that is scaling up very, very fast. But they are paying the price for that growth right now through higher borrowing costs and that exposure to market swings. And the lower capital ratio means they have less room for error than they did before.
But that core engine, the interest income, is so strong.
It's very strong. If the market stabilizes, if interest rates calm down and currency fluctuations smooth out and those huge trading losses disappear, that $8.5 billion in interest income could flow right to the bottom line and profits could skyrocket.
So it's like a coiled spring.
Potentially, yeah, a big one. But management is playing it safe with those extra reserves, even if the auditors don't love it. They know the risks. They're betting on growth, but they are wearing a helmet.
It really makes you think about the strategy here, which leads me to my final thought for you listening.
Let's hear it.
With borrowing from other banks literally doubling and trading losses eating into profits, is Burgan Bank's aggressive 2025 expansion a calculated risk that's going to pay off massively when the market stabilizes? Or have they exposed themselves too much to the very volatility they're trying to hedge against?
That is the multi-billion lira question, isn't it? We'll have to wait for the 2026 reports to find out.
It certainly is, and we will be right here watching. That's it for this deep dive. If you enjoyed this breakdown, please do hit that like button. It really helps us out.
And don't forget to subscribe to the channel so you don't miss our next financial mystery.
If you know anyone interested in banking stocks or just the Turkish economy, please share this with them. We want to get these insights to as many people as possible.
And if you'd like to support the channel directly to help us keep making these videos, please consider evaluating our membership options.
Or you can always use the super thanks button right below the video. We appreciate every single bit of support. Thanks for listening.
Goodbye, everyone.